What's going on, everybody? My name is Jason and I'm here with X91Investing. In this video we're going to be looking at Forex positions, right? So I've noticed that in a lot of my videos I've been talking about very advanced kind of topics and kind of skimming over the basics and kind of taking for granted that we know the basics. So basically when it comes to Forex, you can't be involved if you can't open a position, and this is what this video is about, right? And people have been getting on to me about making the videos a little bit shorter because they have been dragging on a little bit, so I'm going to try my best to keep this one nice and short. So right, we crack on with it, right? So we have a long position. So these are the two fundamental parts of trading anything, right? You go long or you go short, you buy or you sell, right? So when I talk about when you go long, going long is the easiest thing to understand. You buy something, you hold it. When it increases in values, when it increases in value, you sell it then afterwards and you make the profit. You buy it for 8, you sell it for 10, you make €2 profit or $2 profit, right? That's the example that's on screen. But when it comes to shorting, it's a little bit different, right? With shorting, right, the way to understand it is your broker lends you, when you want to short, say a stock, say you take Apple stock, right? Pretend Apple stock is valued at $10. You take one Apple stock, one share in Apple, and you sell that. Your broker gives it to you on loan, and you sell it, right? You just sell it to the market. Someone buys it, right? And you get the $10 for it. But you hold that because you think it's going to devalue. So you still have the 10, and the price goes down, and you buy it back from someone else, and you buy it back for 6. So you make $4 profit on every single one of those shares. Say you only had one, you make 4. If you had, and then the profits multiply obviously with the more lots or the more shares that you hold. So yeah, long is buying and selling, shorting is selling and buying back, right? Simple. Shorting is more expensive to do per position than long trading. Short is short for a reason. You're in, you're out very quick. Markets usually fall faster than they'll grow as well. So when you short, you're in there for less time than you will be for a long position, and it's an incentive to get out quicker because they do charge you more the longer that you spend in a position, right? So next up is the order types, right? So there's two main types of orders. There's a market order and there's a limit order. These are the ones that mainly concern people in the Forex markets and maybe sometimes in the stock markets, because you have limit on open, limit on close, and all these things to do with the open and closing of the markets. But when we have the likes of the Forex markets, it's not always like that. Like, you have the open on the Sunday evening at 10:05, you close on the Friday evening as well. But so a market order is if you click market order, whatever the ask price is, you buy it, right? You buy at the ask, right? The ask is what someone is willing to sell a particular stock, sell a particular amount of currency, or whatever. So when you issue a market order, it's a very aggressive way of entering the market. And if you enter the market aggressively, it can cause volatile little movements in a particular pair or a particular ticker or different symbol. And then likewise, if you're short, you're going to be paying the bid. So you're long, you pay the ask. You're short, you pay the bid, but you pay whatever the current price is, exactly to the decimal, and it can slip. So price can slip at these particular points. So that's why market orders are aggressive. Price can slip, and you can actually get a worse price for what you're looking for. Whereas limit orders are much more passive, kind of calm, like easier ways to get into the market. You place your limit order, and when price gets there, you enter. So whether it's above or below, whether price is above your limit or below your limit, you could have a limit at $10 and the price could be at $9.50. When price gets up to 10, you enter a buy position, say for example, and price keeps going up. Wouldn't be the best kind of a position if you were waiting at $9.50 for it to go up to 10 to make a buy. If you knew it was going up that much, why wouldn't you enter here and catch that move? Because a 50-cent move on a stock is quite considerable. On a $10 stock would be quite a considerable move, but that's only hypothetical anyway. So yeah, market orders are aggressive, fast. You're in at that particular point in time. Limit orders are based off of price. So market orders are time based, limit orders are price based. And next up are your most important parts of actually being profitable are your stop losses and take profits. Your take profits and your stop losses. And I have stop loss with red asterisks on it because you never enter a position without a stop loss. If you don't have a stop loss, you can infinitely lose money, right? You can wipe your account out in one trade if you don't have a stop loss. You can take as much profit, you can You don't have to set a take profit. You can leave profits run indefinitely, if that's the type of position you want to take, and if you think the profits are there's no cap on the profits, that's up to you. But no, you never enter a position of a stop loss. Why? Because when you determine your position size, you need to know where your stop loss is, right? Your stop loss is your stop loss determines your lot size, and your stop loss is determined the amount you can lose is based off of the size of your account. If you have a €5,000 account, you risk 2%, which is a nice kind of, a nice kind of risk to reward on risking 2% per trade. 5,000, that's €100 on one position. So if you have a stop loss set to 20 pips to lose you €100, so a lot of brokers, you can just type in the amount you want to lose, and you can kind of, the lot size, some brokers, if you type in, I want to lose 100, or you can even put in on some places, you can put in 2%, and you can then adjust your lot size based off of that. You can set the pips, and you can adjust the lot size, and it'll adjust, it'll all adjust itself. Some brokers do it, some brokers don't, but you can have it set, but you always set a stop loss, and I can't stress that enough. You always set a stop loss on your position. Because when you go long, that's another thing I forgot to mention about long. With a long position, 0 is the limit of how much you can lose. So when price goes to 0, it can't go any lower, right? So it's more secure than shorting, because if you short and you don't set a stop loss, infinity is the cap on the amount you can lose. But with a long position, you are limited by 0. So if you're trading and there's 15 cents above 0, you're okay. Because if it gets to 0, it can't go any lower. But if it's at 100 and your stop loss, you don't have one, and your targets are 95 and it runs to 150, you're out. Your account may as well be blown. So so with take profits and stop losses, that's pretty much it. With those, like with the stop loss, I just can't stress enough, you always set one. You always set a stop loss. It determines your position size. You can't open a position without one, because it is part of the determination process of your position size. Because you're not going to open a position of you won't open 5 mini lots without good risk. Well, obviously you won't have an account that size if you're not good at managing risk. If you start off with a good strategy and good risk management and good psychology and all that, there's no limit to the amount of money you can make with the markets. But without a stop loss, you're at nothing. You cannot profitably trade without a stop loss. You can without a take profit technically, but a stop loss is the way to go. It limits the maximum amount you're comfortable with losing, basically. And a lot of people will say, and I've said it before, you always leave your trades run to your stop loss. That's a rule of thumb, because if you set a stop loss, you're okay with losing that amount of money. But if you see a trade heading for that stop loss and you know there's no way that's going to turn around, like you just I entered that, it was below the 200, I went in for the buy just below the 200 period moving average, and there was no confirmation that it was going to break above, that was a kind of a stupid trade. Then you can kind of say, when price starts to go against you, you can kind of say, look, that trade, that one's not going to work, that one's destined for failure. And 9 times out of 10 you might be right, or it could be the opposite. You could be only right once out of 10. But the stop loss is there to keep your account there, and provided you use a stop loss system, it will limit the amount that your account can get blown by per position. So you can choose whatever amount of risk you want, but stop loss is the determination factor of a position size. So look, there'll be another video coming about position sizes and all that. But yeah, that's pretty much everything I wanted to go through in this video, because people were kind of saying to me, I don't have a clue what you're on about in your videos, and if people don't understand, I'll have to be a little bit more clear. So I hope this gives a good understanding of when I say, you could have gone long here, you could short here, or buy and sell. Like, longing is for a bullish market, as I might have said in the trend videos. Shorting is for a bearish market. You don't long in a downtrend, or you don't go long in a downtrend. You don't short in an uptrend. You don't sell. Well, you technically sell in an uptrend because you sell to take your profit, and you buy in a downtrend because you're taking your profit by buying the stock back or buying the shares back. So you technically do buy and sell, but you don't enter a buy or a sell. So you enter a buy in an uptrend, you enter a sell in a downtrend. You don't do the opposite, because that's when you're what's called trading against the trend, and that's a whole topic for another video. I've gone on about it before, but those are the kind of fundamental concepts to do with it. So look, lads, I'm trying my best to keep this video nice and short. So look, lads, thanks very much for watching this, and I'll see you all in the next video.